Good morning, everybody, and welcome. For some of you, it's welcome back. For some of you, it's the first time joining us. And today is Tuesday, Wednesday, Thursday, the third day of the 9th Annual Lieutenant Governor Small Business Academy, brought to you again by U.S. Bank and organized by WEDC. This morning's session is developing financial projections. Oh, let's try that again. Developing financial projections. Just a quick reminder that we'll take a Q&A at the end of the session. You are free to enter questions into the GoToWebinar at any time. At this time, I would like to turn the session over to my good friend, Corey Kovacs. Thanks. Take it away, Corey.
Good morning. Thanks for having me, Alex. It's good to see you again. Good morning, everyone. Thanks for being here today. My name is Corey Kovacs, and I work for First American Capital Corporation, which is a nonprofit mission-based lender called a Community Development Financial Institution, a CDFI. Our goal is to serve underserved community members. So we focus primarily on tribal members who live in the state of Wisconsin, but we work with everyone. And what we provide is access to capital for business owners, as well as a TA or technical assistance program. And that technical assistance program provides business development services to aspiring entrepreneurs and existing entrepreneurs. And what that means is if you are looking to start a business and you have not developed a business plan, we walk you through why it's important, especially if you're looking for funding. And part of a business plan are your financial projections. I work with a lot of entrepreneurs who struggle with this element of a business plan. And so I was absolutely delighted to see this session in the program for the Academy this week. And I could not be happier to have this session's presenter to introduce for you today, Luke Kempen, who's the director of the Small Business Development Center at UW-Eau Claire. He has the perfect background and training to help you understand today what financial projections are, why they're important, and how to get started. So thank you, Luke, for helping us out this morning and agreeing to be here and sharing your wealth of knowledge. It's so appreciated and valued. Luke, come on camera. All right, we can see you, but I don't think we can hear you yet.
All right, let's try that again. Good morning, everybody. I'm Luke Kempen. Good to see you all here. Thank you, Corey, for the warm welcome. Appreciate that.
Thank you, Luke.
I'm hoping you can see my screen. Let me try this again. You can see it?
I see your web launcher.
Okay, let me show. Can you see it now?
Perfect.
All right. Oops.
We see it as a PDF in your browser window, I think.
Okay. And is my web? I'm trying to get this out of the way. Can I get that out of there? Is that still in the way, that menu stuff?
No.
Okay. All right, well, very good, everybody. Good morning, then. I'm Luke Kempen. I'm the director of the Wisconsin Small Business Development Center here at UW-Eau Claire. My role is to go out in the community and help people start and grow their businesses. There's SBDC offices located throughout the state. We're part of a statewide network of entities out there. Out of the Eau Claire office, we focus on mainly two things. First, helping people do financial projections. And second, helping people with their marketing, a lot with social media and things like that. My background is financial. I am a CPA. I've worked in the business world for about 40 years. Worked in public accounting. Grew up in some startup businesses. Started my own business. Grew that. Sold that. Did business consulting and joined the SBDC about 10 years ago. And since then, been doing financial projections for our clients. Last year, we did over 300 projections. So we have a pretty good handle on what the bank's looking for and what these projections should look like. So, all right, so let's get started here. Our objectives and agenda this morning is, first of all, we're going to talk about the purpose of these financial projections. We're going to look at the major steps involved in preparing financial projections. We're going to work through and discuss the process of preparing projections. We're going to talk about working with a lender or a bank, and then we're going to offer up some time for you to ask any questions and things that you have. As we go along, you're certainly welcome to type questions in, and then Corey will kind of monitor and host us on those questions at the end. So, all right, let's get rolling. All right, the purpose of financial projections. First of all, I look at, there's pretty much two purposes for projections. The first one would be internal projections. So if I'm trying to do a budget for myself or figure out or project what's going to happen in the future for myself, for my own internal purposes, I certainly can do that. A lot of times we'll call that budgeting or cash flow projections and things like that. So that can be one reason for projections. And a second one, and probably not most importantly, but most common for what we're working on, are people seeking funding from outside funding sources such as grants and bank funding and things like that. Generally, it's the same approach that's used in these, but your audience is different, and there's some differences in what may be needed and what you may need to work through and present. We're going to focus this morning on projections for the bank and for a lender to try to get financing for a project or for a startup. So the major steps in preparing financial projections, it's a 2 or 3 step process. Step one, if you're already in business, you do step one, you prepare the historical information so that you can review and analysis and for comparability. So we look at historical information and prepare that and analyze that. Step two then would be we would detail out the project cost and how you plan to fund these costs. So when I'm saying project cost, I mean, if you're going to be a startup business, we're going to look at what are the costs that you need or that you're going to incur that you need to cover when you start your business. If you're an ongoing business and you're doing some sort of a project, let's say you're going to build a building or expand with some equipment or something like that, then we would detail out what that costs are, what those costs are, and then those would be what we call our project costs. And then we kind of determine how we're going to fund those. And then what the third step is to project the revenue expenses for the next 3 years and then prepare the projected financial statements. All right, let's get rolling into this. So step one, preparing historical information. So the first thing that you need, if you are an existing company, you should have a current balance sheet, okay? And so a lot of people out there may say, well, what's a balance sheet? Well, I have another training session on that I've done in the past. So if you want to learn more about that, check out those training sessions. But let's talk a little bit about the balance sheet. It's your current scorecard. It's the score of your business right now. It tells the reader how much cash you have in the business, who owes the business money and how much money they owe, what equipment and assets you have, who you owe money to, how much you owe, and the payback terms and so on. So things such as accounts payable, credit card, debt, loans, and things like that. The bank's going to look at this balance sheet and assess the risk and if you can handle more funding and that. And so if you do not have an accurate balance sheet, you're going to need to build one because the bank's going to know what the score is. They need to know where you're at before they're going to lend additional money to you. If you're a startup business, you don't have a balance sheet, okay, because you're just first starting. You have no score. So at that point, then, if you're a startup business, you do not have any historical information and no historical balance sheet, you don't need to worry about it. All right. The second thing that they're going to want to look at is at least the last 2 years and your year-to-date income statements or your profit and loss statements. Okay, that's the same thing. Banks put the most reliance on the business tax return statement. Okay, now I work on, like I said, about 300 projections a year, and it happens many times where where a client will give us their tax returns and they'll give us their profit and loss statements, and the two look different. Okay, so what we're going to do if we're working on it, we're going to take a look at that, try to understand what the differences are, and really we're going to reconcile and come out and tie things out to the tax return, because the bank thinks that the tax return is probably the most reliable statement if the two statements don't agree. So the income statement tells the reader what the revenue expenses were in the past, and is the business profitable, and how profitable is the business? Can it support the debt load or the project that we are about to start? The bank's going to look at reasonableness. They're going to look at comparability, comparing internal and comparing it to internal and external benchmarks. Okay, so if you are in a restaurant business, for example, and you show your historical financial statements, and your cost of goods sold is averaging 45% for food costs, and they'll look at the historical restaurant, which is about 32 to 35%, bells and whistles are going to go off in their head, and they're going to start questioning, well, what's going on in your business? Why is your business so different than what is typical of restaurants? Okay, so that's how that comparability works. Okay, they're going to look at comparability then with the projected amounts in the future. So when we start projecting the future years, they're going to look at comparability and say, well, how is the future years compared to what's happening right now? Okay, they're going to use that income statement and your balance sheet to kind of assess your management skills. Okay, can they read the income statement? Is it logical? Are things presented right? Is there enough detail and enough information that provides a fairly good analysis of what the business is doing? And so does your income statement cut it with the bank? So I'm going to give you an example now on the screen. You can see this is an actual client. The names and some of the descriptions have been changed to protect the innocent, so to speak. But this is what we would typically do. So we would lay out, in this case, we laid out 2 years. We laid out last year and then 2021 alongside each other. And you can see the sales breakdown. And then you can see cost of goods sold. So I'm just showing the 2 sections of the historical income statement where we've got sales and cost of goods sold. And so what we'll do is we'll lay it out, and we'll lay out these percentages that you can see in each column, because that's really showing us what's going on here. Okay, so as we're looking across, then we're looking at comparability of different things. So we can see their sales historically are fairly comparable. Bulk of their sales are coming from this item C, and it's about 79 to 80% of their sales. And then they have some smaller items and things going on in there. As we look at cost of goods sold, then you can see I've highlighted this line here, because when we look at this, we can see, oh, proportionally, yeah, maybe it looks okay. But once we look at these percentages, we start to see, hey, this cost for this item C has really risen. I'm going to ask questions about that if I'm the bank. What's going on there? Hey, that's your major item of sale. Why did your costs go up so much? I need to understand that. Okay, so that's the approach that the bank's going to do or use, and that's the approach that you should use when you're looking at your internal financial statements to try to see and try to make an analysis on what they're telling you. Okay. All right, so then once we compile the historical information and build out that analysis and take a look at that and understand what any variances are or big differences and be able to explain some of these things. The next step then is to detail out the project costs and the funding sources for the project. Right? And so these are really the startup cost, or what I call the project cost. So if you're starting a business again, it's detailing out all the costs that you're going to incur to start that business. If you're already in business, but it's a project of some sort, then you're going to detail out that. So what do you need to buy? What do you need to purchase? What do you need to spend money on in order to complete the project? So some of the typical items are land, buildings, and equipment. So if your project involves, or your startup involves, they're going to acquire some land or real estate, you need to lay that out and what that's going to cost. If it involves some building renovation, so whether you're going to buy land and buildings and you're going to renovate them, or you're going to rent, but you have to pay for some building renovations, and that rental you need to detail out those costs. If you need some working capital, what do you need there? Working capital is cash on hand that you may need to get your business launched and operated. If you got to pay some professional legal fees up front, maybe there's some startup marketing or startup training costs, or you have to buy some inventory, or you need to prepay some expenses such as rent or insurance. All the expenses that you have on the front end before you open the business, you want to detail out and list those items out. All right, and those become what we call your uses of funds, or what you need money for. And then the next step then is, well, if you have all these expenses, you're going to have to figure out how you're going to fund those expenses on the front end, okay? So typical items that you can use if you have cash on hand already, if you already have some cash or whatever, you would include that. Maybe you have some investors or family or something that's helping out. Maybe there's some grant opportunities that you're looking at or that you can get. You'd put those on there. Most of the time there's some bank loans or bank financing that you may be looking for that, okay, you would propose that you think you can get from a bank. And other options would be like community loans, like up here in Western Wisconsin, there's Regional Business Fund, and most communities have some sort of loan pool or loan fund that might be available to you. So again, you're going to list out all your sources of funds, okay? So let's look at what the statement might look like. On the screen now, you can see an example of what we call the uses of funds section of the sources and uses of funds statement, okay? And in this case, you can see kind of the detailed listing. So if I have any of these items or whatever, there would be dollar amounts in here, and that would give me my total uses of funds that I need to get this business started, all right? And then what we need to do is schedule out what we think is going to happen with the funding sources, okay? How we're going to fund this. So if we're going to put cash in the business or pay some cash down on our project, we'd list that. Maybe we already have some assets that we're bringing into the business, we might list that. Maybe there's some grants or something like that that's being pulled in, we'd list those things. And then of course, any debt that you might be looking at adding, you would list that out along with the terms of that debt, okay? Is it 6% paid back in 10 years? And then the amount. So we need to know that so that we can figure out what these debt payments are going to be as we're going forward when we're doing the projections. Okay. So you need to run amortization schedules on each loan, or debt service payment schedules is what an amortization schedule is for each loan. And then we're going to ultimately need to capture those debt payments as part of our projections down the line. All right, so we've worked through the first two steps of the project where we're again looking at historical information if we have it, and if we need that, if we're in business or a company that's already in business, we'll have that information. If we're a startup, we won't. And the second step is to list out the project's cost, detail that out, figure those things out, figure out how we're going to pay for that project, okay? And then finally, what we need to do then is project if we do the project, and with the costs that we have and the debt that we're going to have and the investment we're going to make, we need to project out what we think is going to happen with revenue and expenses. Because how we're going to pay the bank back is through generating revenue, hopefully enough revenue versus expenses that can help pay for the debt load and the debt service payments that we're going to have, okay? So this is probably the most challenging part of doing projections, is projecting the revenue and expenses, especially the revenue, and especially if you're a startup entity, because you don't have any historical information to look at to really help guide you in those projections. But we're going to talk more about how we can go about that in a minute. All right. So what we need to do on the revenue is project the revenue, expenses, and other cash payments going out each month, at least for the first year. The first thing, then revenue. Revenue is service or product a customer is willing to pay for. So that's a revenue stream. So a revenue stream is a service or a product a customer is willing to pay for. So for example, if I'm selling blankets, then my revenue stream is blanket sales because I have customers that are willing to pay for that. If I'm selling food, maybe I'm going to have a restaurant that's open for lunch and dinner. Then my revenue streams that I might capture would be lunch sales, dinner sales, beverage sales, something like that. Okay. So you have to look at your business and try to figure out how you're going to define those revenue streams. All right. And then cost of goods sold. So for every revenue stream, we should define if there's a cost of goods sold. Cost of goods sold is direct cost related to that revenue stream. So in my examples, if I'm opening up a blanket store and I'm going to sell blankets, if I'm going to buy those blankets, I'm going to have costs, a direct cost associated with purchasing the blankets. If I'm going to manufacture those blankets, then I'm going to have those costs directly related to the making of those blankets. If I'm a restaurant, I will have food costs if I'm selling food and beverage costs. So those are direct costs related to the revenue stream. All right. Third thing, usually the third or the second major cost involved in any business typically is employee costs then. So we're going to do some work on the employee costs, determine our employee needs, the hours and wage rates for our employees, and list that out. And then we need to finally look at our operating expenses, things like advertising, insurance, supplies, utilities, and so on. And then again, don't forget the debt service payments that you're going to have. So let's take a look at how we can project out revenue and expenses. So I'm showing you a table right now that we use typically to help people work through how to project revenue for their project. So you can see in this case, if I'm selling blankets and pillows, I'm going to open up a blanket and pillow store, let's say. I would detail out, okay, well, those are my two revenue streams. And then we're always trying to equate everything into an average unit selling price, okay? In this case, if my average blankets sell for $100, then I would say, okay, yeah, my average selling price is $100, and let's say my pillows are $50. Now, you may have blankets ranging in selling prices from $100 to $1,000 or something like that. Okay, then you have to kind of decide what you want to do. You need to break down your blankets into maybe some categories like, low cost blankets, medium cost blankets, high cost blankets, or something like that. But generally, you don't want to get too many revenue streams that this gets too unwieldy. Okay, so I would tell you, hey, group some things together if you need to. Another way to look at things is this. If you remember back at that one actual financial statement we looked at where we said 80% of their sales was from sales of item C, a lot of times most businesses, the 80-20 rule is in play. Okay, so 80% of their sales comes from about 10 to 20% of their items. So hey, then let's focus on those major items. Let's detail those out, and then let's put everything else in other revenue and just throw a number at it. Okay, because it's going to be relatively immaterial in what we're doing. Okay, now this is for a startup. If we're already in business, then we should have some information already that we can use to help us build this out, right? If we already are selling blankets and now we're going to expand into a new blanket line and build a new blanket maker or buy a new blanket maker, then okay, we may say, okay, new blankets as a new revenue stream, but we can use our other historical information to help us determine what our current selling price is, what our cost of goods sold is, and so on our current blankets that we're selling. Okay, so once we get these two items here, unit selling price, cost of goods sold percentage, then what we are actually projecting then is the amount of the unit or the number of units we think we're going to sell of each one of these revenue streams. Okay, and so things we need to consider when we do that is, first of all, is this business seasonal? All right, if it's seasonal, let's say this is January, and as we're going along here, maybe we're going to see that, hey, as it gets colder, October, November, December, we're going to sell more blankets because it's colder. Okay, so we've kind of built that in here. Another thing we need to consider is ramp up. So if this is a startup, we need to think about that ramp up, especially in a startup situation, because typically you don't just flick a switch and everybody comes to your new business. It takes time for people to know that you're there, to build that customer base, and get things rolling. So in this case, we did a ramp up. I think I did over a 6-month period, kind of reaching a point in June. But hey, if this was January and this was June, then we know that, hey, we got some summer months that are going to be less blanket sales. It starts getting colder. Now we got some seasonality in play and things are moving more. Okay, so again, this is just to show you to think through the logic of, is there seasonality involved and how might that affect our projections? Okay, now you can use this for a lot of different things, and sometimes you got to modify your approach if you got more complexities involved. So this is kind of a foundational table that we use, and then typically, let's say if we had several components of cost of goods sold, we might build some more details out over here in an Excel spreadsheet and then feed them all in here. But basically, this same structure that we have here, we use on pretty much every set of projections. So again, then that structure is defining the revenue stream, determining an average selling price, figuring out what the direct costs are, material costs and so on, or manufacturing costs involved in that revenue stream. And then we're projecting out the number of units that we think we're going to sell. Okay. If this were a restaurant, it'd be the same thing. We may say, okay, this is breakfast here, and our average breakfast selling price is $15. Our cost of goods sold is 35%. And then we're going to project out, okay, month one, we're going to start this restaurant. We may project that we're going to serve, I don't know, whatever the math would be on there. We might do it on a weekly basis and then multiply it out and work through the math, but assuming there might be some sort of a ramp up going with that. Okay. So again, this structure works very well pretty much with any revenue stream that you're trying to deal with. All right, in our case then, we have our template set this up then. So once we have unit cost and production, or the number of units we think we're going to sell, it's a simple math equation to multiply it out, right? So hey, we're going to sell 20 blankets at $100 a piece. We're going to fill in our revenue table down here, and this builds out our revenue table for us, okay? So all we're doing is taking the selling price times the unit sold for each of these items as we're going across. And then in this case, we're taking the cost of goods sold amount per unit sold and filling in our cost of goods sold table, okay? So you can see we have two elements then of an income statement. The first two elements, we have our revenues and our cost of goods sold section of our income statement. And these will just feed right into the income statement with that approach. All right, then we're gonna also look at, we talked about projecting our employee cost, right? So what we've done here, what we typically recommend that you do is you list out the employees that you need or that you have, so that we can see what's going on and forcing you to think this through. So especially if you're a startup entity, we like to have you list out your employees for the next, we have them list out first year, second year, third year if you think you're going to expand and add employees, because it forces you to think through your specific employees. It also forces you to think through coverage, okay? So if I'm a restaurant, maybe I'm closed on Monday, so I don't need any employees. But Tuesday, Wednesday, Thursday, and then Friday, Saturday, let's say are my busiest days, maybe I need more employees. So building out a table like this will help you to think through what your employee needs are, okay? I would include myself in here if I'm the owner, and typically what I would do is not show any pay rate to the owner, because I want to see what this business can do before the owner takes any money out of it, okay? As we all know, if you are business owners already, who's the last person to get paid each month? It's the owner, okay? So we really want to just show this before any payments to the owner. So I build out my employees, put a pay rate in there, and if they're working 40 hours a week, I may say, yep, 8 hours Monday, Tuesday, Wednesday, Thursday, Friday, 40 hours a week, 52 weeks. And then this is set up to calculate all these different things. We've set some parameters in here with payroll tax rate, if there's employee benefits, if there's workers' comp, and what that typical rate is. and then we'll build out these tables for 3 years, okay, in our projections on there. So this is something that you can do. I'm giving you these examples because you could build this out if you're handy with Excel, or you could reach out to your Small Business Development Center and they can certainly help you out with this too. All right. Then once we have the employees, then we're the remaining expenses that we have to project then would be our operating expenses and the debt payments that we're going to have. Okay, so I've included some typical operating expenses in here, and depending on how you want to do it, you can put a monthly amount in here or an annual amount and then divide it out by 12 or however. You know, this is just a place to kind of gather those expenses so that you have them, so that when you build out your financial projections, you can tap into those and feed them into your projections. So these are some typical things there. You can see I like to detail things out, especially if you think about it. Typical, if you have land, buildings, and equipment, your business consists of that. I'd like to see details on the utilities broke out. A lot of people come in and say, yep, utilities, and they throw it's a $1 amount all lumped in. I like to break things out because then I know that I've included it. If I break it out, I can see, yep, I got the gas and heat, I got the electric, I got the water and sewer, I got internet, Wi-Fi and cable, I got the phone, okay? Sometimes if it's all grouped together, I'm not sure what's all in there and if it's complete, all right? And then you're working down through these different things. And these are just sample ones. You may have different types of expenses that are, you know, because your business is a little bit different, then you would certainly include those in there. And then finally, you would figure out the monthly debt payments with some amortization schedules. And so you know what those are each month, okay? So now we have revenue. We've projected revenue, cost of goods sold, our employee costs, and our operating expenses. All right. So let's take a look at what a typical then income statement cash flow projection looks like. All right. So in this case, this is our kind of standard structure of what we have. And you can see we built out that revenue table, and then I've just fed those numbers into our monthly income statement, cash flow statement. For our revenue, I fed in our cost of goods sold information. In this case, I didn't do the employee wages yet, but we would put those items in here, payroll, taxes, benefits, and then feed in our expense items in here on a monthly basis and work through this process. And we would develop a what I call net income before operations, and then we would have to add in the debt service payments in here, okay, to get our net cash flow. All right. What the bank is looking for is cash flow, because that's what they know is going to be used to help pay the debt off, okay? And if you set this up the way we've got it set up here, this bottom line number is after all your expenses are paid and after the debt service. So this is what the owner would have ability to take out to live on or to reinvest in their business each month and then for the year. All right. And so what we typically see, at least the bank wants to see, is the first year of projections, they're going to want to see it broke out by month. All right. And again, the reason for that, we talked about the two major reasons, right? The first one is, hey, if it's a startup business, we're going to have some ramp up probably. And you can see that we're ramping up sales over a period of time. Second reason would be, is this business seasonal? If I'm a lawn mowing business, for example, I probably am not going to have revenue in January or February unless I'm plowing snow or something like that. But we need to consider the seasonality of our business and show that. Because if we were a lawn mowing business, we may end up down here where we have a negative cash flow going on in these slow months, and then we are really, filling up our bank account, so to speak, during the busy months, and then again the slow months, we're pulling money out of our bank account. Okay, and guess what, folks? bank typically doesn't shut the payments off and allow you just to pay during the busy season. Bank wants monthly debt payments each month, whether you have seasonality going on in your business or not. They need to make sure that you can make those payments every month. Okay, so they're going to be looking at this to see how this thing looks from a cash flow standpoint during the peaks and valleys of your business. All right. We talked about the income statement. Then this is the sources and uses of funds statement. We kind of worked through that before. Again, this is the uses of funds section of that. Your uses of funds need to equal your sources of funds. So again, you've gathered that information and you can put that in and make sure it's in the statement form. This is kind of the first statement that the bank looks at when they're going to look at your set of projections, because it tells the bank what you want from them and what you're looking for and what you're trying to accomplish and achieve with your projections. So what you need from them. Okay, and again, it lists out what your costs are and what debt you're proposing and going to ask the bank to finance. All right. Let's turn our attention now to working with a bank. When to talk to your banker. So people come to me all the time and say, when do I talk to the banker? Well, I've got a great idea and I want to talk. I know I need some funding. I'm going to go talk to the bank, right? Well, that's might not be the best approach, because the bank can't do a whole lot for you until you've thought it through and put some things down and did your homework first. Okay, so generally, and what we tell our clients is, let's work through this first. The bank's going to need to see a set of financial projections, and typically they want to see a short business plan. Okay, so better off for you to think things through, prep those things up on the front end, and have thought through what you're going to do and go to the bank, because then going to the bank hodgepodgely, oh, I got this great idea, and expecting them to give you an answer whether or not they're going to lend on it. Basically what they're going to do is, oh, that's nice, go back home now and do some homework, do a set of projections, build a business plan, and then come back and let's have a conversation. Okay, so you're just going to be more productive if you have done this first. And also you're going to be, you're trying to sell yourself to the bank too. So if you can go in there and show that, yeah, you gave it thought, you worked through a set of projections, you did some homework, you worked with the SBDC, you got some other advisors on board, and you talked this through and it looks good, they're going to feel a lot more comfortable with your project than if you go in there all hodgepodge and not well prepared. Okay. As far as the business plan goes, this question comes up all the time. What does the bank want to see for the business plan? Well, if you look online and you look up business plans, what do you see? Sometimes it's 60 to 100 pages of business plan, right? Bank's not going to want to look through all that, all right? They want to see something that's fairly summarized, that will basically show that you have the ability to pay them back, okay? And so most important in my mind always is this, that the bank knows that you're going to pay them back through revenue, right? You have to generate revenue and customers in order to do that. And so most importantly in my mind and the banker's mind typically is, how are you going to get and keep customers to generate the revenue you need to cash flow this business and pay me back? So your business plan needs to focus a lot on marketing, getting, and maintaining and keeping customers, okay? The other thing that I would tell you is this: let the financial projections, the numbers that you prepare in the projected financial statements, be your numbers that you're giving to the bank. In other words, I would not write a whole bunch of narrative in the business plan with a whole bunch of financial projection numbers in there. First of all, you're probably going to be working through these projections many times, okay? And if you change a number in the projections and then you forget to change it in the narrative, now you've created a question, right? So for example, in the narrative, if you said, yep, my first year sales are going to be 500,000, and you did that, and then You work through 3 or 4 drafts of your projections, and pretty soon now you're showing that your sales are going to be 300,000 in the projections, but you forgot to go back and change them in your business plan narrative. Then you've got disharmony, right? And the bank's going to ask, well, it says 500 here, it says 300 there. Did you think this through? What's going on? So the easiest thing is let the bank rely on the projections, the numbers from the projections. That's all they need. Use your narrative to talk more about the business, the idea, and how you're going to get and keep employees. All right. All right. Your conversation will be more productive if you prepared all the stuff first. The projections need to be reasonable and logical as a starting point. Okay. So I was just the other day, I had someone come in and they had projected that their sales were going to be 39 million in the first year, 55 million in the second year, 79 million in the third year. Okay. And they were looking at, they were going to buy a building and do some renovations. So it's about a $5 million project. Okay. Now, first thing, if I were the bank and you show me those numbers, I'm going to be, boy, geez, this is really aggressive, right? Probably hard for me to believe that as a startup, you're going to have that much in sales. Okay. Now, God bless you if you can get that much in sales, but you don't need to show the bank that you're going to have $50 million in sales the first year or whatever, right? You're not going to impress them with that. You're going to scare them off. So better for you to be conservative and look at this more from a standpoint of, well, what do I need? What do I maybe need to project to pay the debt and have a reasonable return on the bottom line? So maybe I need to be conservative with my approach. And yeah, if I can get $39 million in sales the first year, that's great, but I don't need to show that to the bank. I only need to show about 5 million in sales to cover the debt service I need and to show that I can cash flow this business. So I'm going to be more conservative, because then the bank's going to ask me less questions and they're going to feel more comfortable with what I have. All right. All right. Other things working with the bank. Credit score is critical. They're going to want to know what your credit score is. If your credit score is too low, they generally will not fund your project. Okay. So that's your personal credit scores, a personal credit score of you or any partners or spouses or anything involved in the business. All right. The bank will not fund 100% of your project. People come to me all the time. I'll just get a bank loan and fund this all. No, that's not going to happen. The bank wants collateral. Okay. The best collateral the bank can have is real estate. Generally, a bank's willing to lend 75 to 80% of the value of the real estate if they're looking for real estate financing. If you're looking at equipment, generally 50 to 65% of the equipment the bank's willing to lend on. Inventory, bank's probably going to say, we will give you a line of credit for that. That's it. Working capital, probably a line of credit. Goodwill, maybe a line of credit. Okay. Why is that? Because these things, inventory, working capital, goodwill, are items that can disappear fairly quickly, or if the business goes south, they usually can't sell. For example, you can't really sell goodwill on Craigslist, right, to recover your investment. So they know that if they lend money on this and the whole project goes bad, they're probably going to be out on this stuff. So generally, they're not going to want to lend on there. Now, if you have a lot of these items involved, let's say working capital, goodwill, then the bank may reach out and use what's called SBA 7A loan or express loan guarantee programs. They'll look at some programs that might come in, and then the bank may be able to lend more because the SBA is going to guarantee some of this debt to help protect the bank in case the project goes bad. All right. So just be aware of this because it's important to understand then that, hey, if the bank's only gonna lend on these percentages, that means you may need some more money. You need to come in with some money down. You need some skin in the game, so to speak, before the bank's gonna lend on the project. Some other things that we want to talk about, check out local funding sources. Here in Western Wisconsin, we have what's called the Regional Business Fund available. They are what we call gap financers, so they'll help fill gaps. So let's say you have a project that, let's say it's $100,000. The bank says, well, they'll lend $70,000 and you can put $10,000 in, so you got a $20,000 gap, right? Maybe you can use the regional business fund to fill that $20,000 gap and get this project launched. Okay, so that's kind of how that works. There's cities and communities across Wisconsin have different loan pools and stuff, so check that out. If you've got a business, I would check with your county and city or city economic development organizations. They're the boots on the ground locally that can help you with that. Watch out with those internet loans. I've got more and more people looking at internet loans, but you really got to watch what's going on there. A lot of times these internet loans, they're pulling this out. I've seen internet loans where they're pulling amounts out of your bank account every day, if not every week. Okay, and the rates are typically very high. So be careful of that in there. And then if you need some help, contact your local SBDC office for assistance. They'd gladly work with you and help you out with your projects. All right. So just to wrap up then, we talked about the purpose of financial projections. We talked about the major steps in preparing financial projections. We worked through and discussed the process of preparing these projections and the steps to do that. We talked about working with a banker and what they want to see from your projections. So with that, I guess, Corey, I'm going to open up. Oh, one other slide here. This is kind of a slide, and I think you guys are going to have access to these slides and so on. So I put this in there. This is a slide that if you just want to do project cash flow for your business, this is kind of a simple slide to help you do that. You could set this up in Excel and do that, or reach out to your SBDC office and they can help you give you the slide. So, all right, I'm going to turn it back over to you, Corey, and we'll take any questions.
Outstanding. Well, I think you've already answered a couple of questions that popped in my chat. One of the first questions that came is, are we able to get these slides? So it sounds like we will be able to include those in the resources that are going to be available on the Small Business Academy webpage, which is great. Thank you, Luke, for that. And then I want to just make this question and answer very clear. Someone was asking, will the forms be available to us to print out? And I'm guessing that's either relating to the slides or the templates that you were showing us, Luke. So I guess my question is, if they want to get those templates, do they need to contact the SBDC?
Yeah, unfortunately, we cannot share our Excel template. It is proprietary to our SBDC. So if you do need some help, though, I mean, you might be able to, if you're savvy enough to create some of these. We do have a version that we've used in the past out of Eau Claire on our entrepreneurial training program. I could probably share that with you. If you reached out directly to me, I could do that. But I cannot share our main projection software template because A, it's very complex, and B, it is proprietary. So, but if you need assistance, you certainly can go to your local SBDC office and they can work you through the projections too and help you work through that in the template itself.
Awesome. That is perfect. Thank you, Luke. I have another question here that's pretty specific. It says, I'm hoping to purchase an existing business. I've been in conversation with the current owner, but have not yet seen any financial statements. At what point in the selling process should I expect to see them?
Well, I think you need to see them right away, because how do you know what to pay for this business until you see what the business can do? Okay, so at this point, if you're talking to that buyer or that seller, I should say, if you're the buyer talking to the seller, and I'm assuming the seller maybe said, well, I'm going to pull a number on this guy, I want $500,000 for my business, and you're curious about it, the next step probably should be that you and the seller should ask you to sign what's called a non-disclosure agreement, and then they should share with you some of this financial information. Okay, you're going to need that to determine if the purchase price is reasonable and acceptable to you and what the business is doing. Okay, now the seller is probably going to be nervous about sharing this information with you. Therefore, they should ask you for a non-disclosure agreement where you're agreeing not to share this information with anybody else. But I've encountered where sellers are like, I'm not sharing any information. Well, then how do they plan on selling this business if they're not willing to share any information, right? And if that's the case, I mean, I've got one project right now where absolutely the seller will not share any information other than the business includes real estate and equipment. He shared a list of the equipment and he shared a list of we got the real estate. So basically I said, okay, then what you have to look at this on is basically what is the value of the real estate and what's the value of the equipment, the fair market value of those two things today. That should be the maximum offer price that you're going to give for this business, because it's only worth then the value of the assets, because you don't know if there's any goodwill or what the business is doing because you can't see that information. Okay, so long answer to short question. Yeah, you need to see that fairly soon in the process, because how else are you going to know whether or not you want to continue to pursue this business and whether it's feasible for the asking price.
Excellent, thank you, Luke. Have another question here that says that some of the forms that you were presenting looked a little complicated and beyond the owner's experience in bookkeeping. How important is that accounting for these projections?
Yeah, it's very important to break this down. And, you know, I know it's hard for you to do this yourself. I mean, hence, you know, the SBDC is here to help you out with this. And that's why we end up helping so many clients every year, because it is critical. The bank wants to see this information, and you're going to help your ability to get financing if you have a good set of financial projections. Because again, the banks, just like we talked about with you as a buyer, looking at that seller's information, if the information you're providing to the bank is incomplete, not well prepared, not well laid out, not well understandable, the bank is going to say, it's too risky. I can't really get my arms around this. I'm not going to lend on it. Okay, so I know it's tough for you as a business owner to put this together. That's why I would encourage you to reach out to SBDC, SCORE, or somebody else to give you some help with trying to put this together. Okay, it might cost some money, but I can tell you, having an analysis done and working through this process could save you a tremendous amount of money. We do, like I said, about 350 projections a year. Maybe only half of these projections actually get funded. A lot of times what happens is we work through the numbers and we're saying, you know, hey, it's not feasible, or it's very tight, or hey, that asking price is too much for that business. It can't support the debt load. Better you find that out now on the front end than you end up doing something and acquiring this business, and then 6 months in, all of a sudden you're figuring out that you can't make the payments.
Very helpful, very helpful. Thank you, Luke. I have one more question for you. So if you have been sitting on a question, make sure you drop it in the chat, and we'll make sure we get that answered before our time is up with you this morning. The question is, Luke, you said that it might take a while for an owner to be able to take a draw from their business. And the question is, how long do I need to wait to get paid?
Well, that's a good question, isn't it? You're going to need to wait until you generate enough money to pull money in excess of all the needs of the business. Okay, so first thing is you need to pay, you need to pay the bills and you need to pay the bank. Okay, so if you're generating only enough revenue to cover those two things, then you are not going to be able to take any money out of this business. All right, and so that I can't answer you like, yep, 6 months, that's the cutoff, and then instantly you're going to be able to take money out, because it's going to depend on the ability of that business to generate enough money in excess of the expenses that need to be paid and the debt that needs to be covered before you can take any money out of it. That's why you would do these projections, okay? And that's back to my discussion about, yeah, we do 350 projections a year. If half of them get funded, the other half may come in and say, you know what, it's just paying the bills and it's not generating any money for the person that's trying to start it. And we may look at this and say, hey, how much money do you need to live on? Well, I'm going to quit my job. I'm making $80,000 a year. Well, we're not seeing in the near future where this business is going to generate $80,000 for you to pull out of it. Now you need to decide, can I live on less and on what this, can I live on what this business is willing to generate, or no, I can't. I can't. I'm going to hold off on this business, or I'm going to keep my job. Maybe I keep my job when I start smaller, or I do this on the side hustle or something like that to get it going. Different ways to do that. But that's the reason you would run these projections, to help you understand what this might look like down the road, and when you might be able to pull money out, when you should quit your job, or if you should quit your job, and so on.
Luke, I'm going to follow up on that. If you've already started your startup phase, but you haven't run financial projections yet, is it still valuable to run them when you're in the middle of it all?
Oh, most definitely. I mean, I think you're gonna know more already if you've pulled the trigger on it, and you're already, okay, well, I already got these expenses coming in, I already got these sales going on. I mean, you might know a lot more than you would if you're starting, when we're doing projections from scratch without having been in business or having done anything with my business. So yeah, I mean, and that's basically just budgeting. Even if you're not going to do a project right now, let's say you're not looking for debt financing, whatever, it's basically just running a budget. And in that case, you may look at and say, hey, maybe I just need a simple template like the one that I showed you here, and I got it back on the screen. I don't know if you can see it, but there, just to kind of pencil this out a little bit, see what's going on. Okay, this is what the one I showed you on the screen is. We were helping a lot of businesses during COVID. So hey, especially restaurants, all of a sudden they had to shut down, and we're like, okay, how much cash do you have? How long can you hang on until you can open up again? Or what can you cut for expenses and things like that in order to make this work? So yeah, I definitely, any time is a good time to do projections.
Outstanding. Luke, as always, I've greatly enjoyed your presentation. I love how you collect and disseminate information. It just makes it so much easier to understand. I would like to thank all of our attendees this morning for their focus and for their good questions. And of course, we have Luke's contact information. We'll have the slides available for you as resources. And we have more panels and more sessions coming up this morning, and even in person tomorrow morning at regional locations. So without any other questions, I think we have 3 minutes left in this hour that I'm going to say, let's stand up and stretch and turn our cameras off, and we'll be back at 10.
Thank you, everybody. Appreciate it.
Thanks again, Luke.
Yeah, thanks, Corey.
And thank you all for attending this session. And to both of our speakers this hour, Corey and Luke, we will take a short break and return at the top of the hour for our next Wisconsin Lieutenant Governor Small Business Academy session, Financing Your Business, Getting to Yes, a panel discussion. And just as a quick reminder to all of you listening on this session, our keystone sponsor is US Bank, and the Small Business Academy is organized by the Wisconsin Economic Development Corporation. Please visit www.sbeacademy.com for our Small Business Academy resource directory. And we'll see you here shortly at 10 o'clock. Hello and welcome to the Wisconsin Lieutenant Governor's Small Business Academy. This hour's session is Financing Your Business, Getting to Yes, a panel discussion. Just as a reminder to all of our attendees, our keystone sponsor is US Bank, and this entire conference is organized by the Wisconsin Economic Development Corporation. If you have not yet, please visit our resource directory at www.sbeacademy.com. And now, I would like to turn our session over to Patrick Martin. Please put your questions in the chat, and we will take them at the end of the session.
Good morning, everyone, and welcome to the 22 Small Business Academy session, Financing Your Business, Getting to Yes. My name is Pat Martin, and I'm a business lender here at Landmark Credit Union. Our session today will be discussing the importance of your banking relationship prior to your loan request, being prepared with what's important to have before meeting with a lender, with the ultimate goal of getting your lender to say yes to your requests. I will introduce our panel today. We have first Therese Carroll, who is the CEO of RC, or the Legacy Redevelopment Corporation. On a side note, I wanted to also congratulate her again. She's been recently awarded the 2022 SBA Wisconsin Minority Small Business Champion. Congratulations again, Therese. Next, I'd like to introduce Rick Zawicki, who is a loan officer at FCC, or the First American Capital Corporation. And finally, I'd like to introduce Wesley McKenzie, who's a business banker at US Bank. Our session today is about an hour, and each person will be getting about 10 or 15 minutes to present their material based on their company and their positions. We'd also have about 10 or 15 minutes at the end of the presentation to open the floor for any further questions. At this time, I'd like to introduce Therese Carroll to the floor.
Good morning, everyone. Thank you, Patrick, for the introductions. Again, my name is Therese Carroll. I am with Legacy Redevelopment Corporation in Milwaukee, Wisconsin. We are in the center city of Milwaukee on the corner of 16th and North Avenue. We were established in 2003 to be able to address small businesses in the city of Milwaukee that would need assistance with financing. Move the slide. Legacy Redevelopment, again, is a community development financial institution, so we are not a predatory lender, nor are we a traditional bank or credit union. We are mission-based lenders, and our mission is to provide strategic lending solutions and ongoing support to Milwaukee's small businesses and nonprofit organizations to foster financial independence, sustain growth, and revitalize our communities. Our vision is always to empower urban businesses and organizations to be self-sustaining and achieve their financial goals. Next slide. So what is the role of a CDFI? What we do is to provide financing to small business owners who typically do not qualify for traditional lending. And that typically could be a variety of reasons. Some of our loan clients, they may not have all the financial needs, the down payment that they may need to put into a commercial deal. Maybe there's some blemishes on your personal credit. Maybe your net worth is not as high as it should be. Those are our standard loan clients that we work with. I define our CDFI as an interim financing source because we don't do predatory lending where we're paying astronomical rates, nor do we have the traditional bank or credit union rates. We're right in the middle, and our goal is to get you to a place where you are bankable. So we are an interim financing source. Our goal is to graduate you out of the CDFI world into a traditional bank or credit union. Another thing about a CDFI is that we only lend to specific target markets. Right now, Legacy Redevelopment lends to the city of Milwaukee, and we are also now new to the city of Racine. And our final goal is to prepare all of our loan clients for bank readiness. And we'll discuss that a little more further into the presentation. Next slide. So the big question is this: what do I need to do to get to a yes? One of the most important things that you should have available to you is a business plan. A business plan kind of gives a lender an understanding of where you are and your readiness to be able to get funding. A business plan means you thought this out. A business plan invites a lender to visualize your business. So there are a few things that your business plan should have. And I don't want anybody to make an assumption that you have to come with this huge presentation, but there are some key parts of a business plan that should be present. The first thing, at minimum, you should have a mission and a vision for your business. That means that you know exactly what you want to do and how you want to do it and who you want to do it for. That's key. A detailed description of the product or service your business will offer, who will manage the business, and also provide background on those people, the owners and the operators. A lender wants to kind of know if you have experience in this area. It helps. It makes a lender feel more comfortable with the investment that they are going to make into your business. A marketing plan. You should be able to say to a lender, this is my market. These are the people that I want to touch. These are the people I want to offer my service to. These are the people that I want to give my product to. And so there are conversations around what that looks like, and is there a demand? So those things should be in your business plan. And finally, and probably one of the most important things that you will need, are financial projections. Financial projections give a snapshot of what you think your business will be able to make over the next couple of years. That should be realistic. There should be thought put into those projections based on whatever is going on in your particular area based on economy. So those things you need to take a look at when putting together financial projections. For legacy redevelopment, a business plan does not need to be 25 plus pages. I said that earlier, but you need to have a business plan to start. Next slide. Financial education is key. When you meet with a lender, there's going to be conversations around you personally. There's going to be conversations around your business, whether it's a startup or an established business. So financial education, knowing certain things about yourself, knowing certain things about your business are going to be key. Understanding your personal credit health. You should know where you are when you meet with a lender as far as what is on your credit report, around a good gauge of maybe what your scores are. Every year we're able to get a free credit report, so you'll be able to see what is on your credit, if there's derogatory things on your credit, if there's something that's shown that was not paid on time. So you'll have everything in front of you, so when those conversations come up, you'll already have an answer. So on the personal side, you may say, well, this is for a business. Why do I need to give anything personally? Most lenders will require you to personally guarantee your banking debt, okay? Your business debt, I'm sorry. So we will, at Legacy Redevelopment, ask you for the last 3 years of your personal tax returns with all schedules. You'll need to complete a personal financial statement. A personal financial statement, or how lenders will refer to as a PFS, is just a complete overview of all your assets and your liabilities. And at the end of it, it will tell us what your net worth is. And then if you have a personal resume, sometimes a resume kind of helps to give background on that experience, as I spoke to earlier. So sometimes we will ask you for your resume as well. Next slide. I missed a point. Last thing from that prior slide, for legacy redevelopment, if anybody's wondering, I talked about credit score. Credit scores are important, but we are not a score-driven lending institution. So there is no minimum that we would look at. You wouldn't have to come in with a 680, a 700. We look at the meat of your credit report. If there are blemishes on the credit report, if there's derogatories on the credit report, we will have to discuss those, and we'll have to have an explanation before we could take it to our loan committee. So on the flip side, for your business, understanding your business's financial health speaks volumes. One thing that lenders normally will ask, especially for an established business, are what are your revenues? What are your estimated revenues? What are your estimated expenses? Have an idea of what that is. It will help in conversations, because initial conversations are going to be about whether or not your lender feels like they will be able to assist you. So some of those upfront questions will help to drive the next steps of getting this application process started for you. On the business side, if you're an established business, providing 3 years of your business taxes with all schedules is required. If you're a startup, we talked about those projections being in your business plan. If those are new, fresh numbers, we can use those from the business plan. If not, you'll need to update those or provide new projections, and we look at a minimum of 3 years. In some cases, we'll ask for your business's taxes plus projections, because depending on what you're requesting, your ask is, your business's projections will help to say you'll be able to support debt moving forward, okay? Because it's going to change your financial position. And then we may also ask you for year-to-date financial statements. If you don't currently capture at minimum a profit and loss statement, that's something you might want to consider starting. Year-to-date financials will help to give a snapshot of where you are in current time. So you have your taxes that were completed, but if you're in the middle of the year, we're already in May of 2022, we might want to see how the business has done since the beginning of 2022, just to make sure that the business is still profitable. Other supporting documents that we look at to be able to support doing a loan, if you have contracts, those are dollars that you will potentially be getting down the pipeline, right? Accounts receivables, those are dollars. That's money, revenue into your company that you haven't collected yet, but you will. Letters of intent also help to support maybe services that you're going to be offering, maybe a store that you're going to be putting your product in. We look at all those things to be able to put together a loan proposal with the hopes of getting a yes from our loan committee. Next slide. So underwriting, all of our loans receive the same underwriting. It doesn't matter if you're applying for $5,000 or $50,000 or $250,000. Underwriting is always going to be the same. The things that we look at, can this business support this debt? So you need to be able to demonstrate that your business will be able to support your current debt and the debt that you're asking to borrow. We also will look at, as that personal guarantee piece that I talked about earlier, can you as the owner support this debt? Do you have any outside income? So for any reason that your business may fall on hard times, or you have to, God forbid, close your doors, will you be able to pay off this loan? And then we'll look at it globally. We'll say the business plus the owner, can they both together collectively pay this loan back? Those are the things that we look at. And this is all in an effort to be able to establish a proposal to be able to get you to that yes when we go to our loan committee. Next slide. So I'm sure many of you have heard of the 5 C's. 5 C's have been around for a very long time. And we do look at these and we make great consideration. The first and most important one in the order that I put them is character for legacy redevelopment. Character speaks volumes for our loan clients. And that's why we establish such a good rapport with our loan clients, because there's a lot of conversations. There's a lot of thought that's put into how this is going to be executed. And character tells a lot about, believe it or not, maybe much more of how somebody will pay back debt, the biggest. And capacity, collateral. Sometimes collateral may be minimal, but there are certain things that you still might be able to pledge to be able to strengthen your request for a loan. Next slide. So securing your loan, for most loan deals, they are secured by some sort of collateral. And it could be a variety of things. Of course, the most important probably would be for us is real estate. We do a lot of real estate deals. You can use your home as additional sources of collateral if there's equity in your home. Automobiles that are free and clear, we will take a look at those. Inventory and equipment, we look at and place values to your inventory and your equipment. If you're a startup and you say, I don't have any of this stuff, well, with your loan, 9 times out of 10, you're going to be purchasing some sort of inventory and equipment or a vehicle for your business. We will use that as collateral. Most deals will require you to put some type of skin in the game or sweat equity. We look at sweat equity just like we would if you were putting physical cash in. We want to see a minimum of 5% into any deal that we take a look at, because this is an investment into your business. So if you're not willing to invest in your business, we have to second guess why we would. This is your business. This is something that you're going to grow, that's going to be successful for you. So sweat equity, if you've already put time in, if you've already did some build out to acquisition rehab project that you're working on. If you're doing a restaurant and you've already started doing improvements to the restaurant, we take into consideration dollars that have already been inserted into a potential loan deal. Next slide. Interviewing. I cannot stress enough this portion of your application process. For a lender to get a better understanding of who you are and what your business is, there should always be a formal interviewing process. And sometimes there's going to be a couple before we can get you to a yes. Don't get impatient. Just know that we're building a story. We're trying to gain clarity on what your needs are and how we can best assist you. The lender interviews you, and you also should interview your lender. When there's questions or things that you don't understand about your process, make sure you ask the question. If there is a time where, unfortunately, at the time we're not able to give you a loan, if your lender does not provide to you an explanation as to why, you should ask the why. And that's where that interviewing us comes into play. Don't walk away with not an understanding of what you need to do to maybe improve on your business plan, to improve on your financials, to maybe clean up your credit. Those are conversations in one of those interview meetings that you have that should take place. Next slide. Okay, thank you.
And we thank you, Therese. We greatly appreciate your time today and all that useful information. Next is Rick Zwicky from FACC. So Rick, please take it away.
Good morning. My name is Rick Zwicky. I'm a loan officer at FACC. And I will be discussing what FACC can offer to get your business to a yes for financing your business. Some of this will be similar to our fellow Cdfi. Teresa did a nice job there and kind of highlighting some of the things. So you'll see some of the same things, but some differences. First off, let me discuss who we are. Next slide, please. All right, so FACC is a 501c3. We're a CDFI, mission-based, mission-focused lender. Like I said, similar to Therese there. Our mission is basically to provide business development activities or provide business loans, technical assistance. We're also an SBA micro lender, and we basically are here to try to benefit the Wisconsin Indian community as well as the underserved communities. So minority, women-owned, low-income startup. Similar as what you heard before, we're here to fill in where the banks and to basically help to coach and offer services to eventually get you bankable. Next slide, please. So here are some of our business products and services that we offer. Fast track loans, so 20,000 and under, an abbreviated loan that we can kind of move a little bit quicker on. We also are, like I stated before, SBA micro lender, so up to $50,000 we offer the microloan products. Basically, we go from about 5,000 to about 250,000 in loans. We would kind of, some of our specialties is we do contract financing, which in a slide coming up, I'll kind of touch a little bit more on that. And then for the probably 5,000 or down, you know, Kiva's a partnership organization, crowdfunding that we kind of look at for you to maybe you're in that early stage and you're just getting together the business plan and, you know, what's the word, these side hustles, kind of get that Kiva loan going. And then that would maybe graduate into us maybe doing a fast track loan or a smaller variety, and then working up maybe to something larger, and then again to be get you to the bank. We also offer a pre and post loan technical assistance. That's a big part of what we do. And I'll kind of highlight a little bit more. Here are some of the basic highlights to that, the business plan preparation and getting ready for the loan, marketing, you know, and then really kind of getting ready to get that loan and everything that it takes. Next slide, please. So here we'll talk about some of those typical loan requirements that we would need. First off, loan application. We get the basic information, financial statements, tax returns. The financial statements, that's some of that technical assistance to put together pro forma projections for your business. That's when we'll also work with some of these SBDCs you've heard of, the small business development centers, or we have on staff also to try to facilitate getting together those initial statements, projections, things of that nature. Like I said, you got to get together your tax returns, your personal financial statement, you know, the operating budget and cash flow. That's some of the projections and so forth that we're talking about. And then from there, you know, once we get that picture is kind of when you would put in more of the formal application. Next slide, please. So this, we're talking a little bit about the type of loans, equipment, working capital. So you got a low down payment requirement. We typically do 3 to 6 year loan term. Rates vary in that 6 to 9% range. We also can accommodate seasonal payment structures. So depending on the nature of the business, if this is an existing business, designed to help to grow the financials and finances, absolutely. Focus, we definitely focus on equipment that generates revenue for you. So, you know, that's a good portion of what we do, from truckers, get the truck to get out there and do your business. Next slide, please. So this is a specialty of FACC, so the contract financing. So this is to help you when you get that contract. So, you know, to help finance labor, the fringe, you know, your union type things, materials, equipment. So you get the contract, we sit down, put together a short term, you know, whatever the term of that contract is, and put together some financing, and then we'll get repaid when you collect that receivable, when you when you collect on that job. So, you know, it's very project based. It's something that we definitely do a good amount of, and it's a nice feature that we offer there. Next slide, please. So FACC's lending approach, the main thing to remember here is, you know, where Cdfi is not a transaction, it's a relationship. And that's where, you know, where the whole package from the technical assistance up front, helping you to put together that your dream, and then make it an actual reality by putting together all the things that it takes to get it done, from the projections and the financials, and you know, some of those things that Therese was touching on, you know, the having some skin in the game, and kind of getting you to that area. Business loans have a much different criteria than personal loans. Every deal is different. So, you know, your situation is completely unique, and you know, that's what we're good at, is looking at every deal on its own merits. You know, we'll talk a little bit about the 5 C's of credit. You know, kind of hit on that too. And it's character is a huge part of that for us, because that's, you know, early on you don't have the 3 years of history, you don't have the things that the banks are looking for. So as a CDFI, you know, we're looking at that passion, that the character, you know, the work you're putting in, and you know, are you doing everything that it takes to get there to make this happen? And that's what we're as a mission focused lender really trying to achieve with you. Next slide, please. And this, you know, is the 5 C's we kind of talked about, but you know, I just want to reiterate, there is, you know, with us, that character is definitely a high importance. Although, you know, definitely we want to look at collateral, we're going to look at, you know, the capacity, how much capital. The other thing I want to touch on here too, and you'll hear this in other ways, is a global cash flow. So you're starting a business, and right, you're already working at a job, making good money, and then you want to start a new business. You know, how are you going to pay those bills? How are you going to, you know, keep your household running and everything else? So global cash flows, you want to kind of look at that too, in the big picture of things, is, you know, how am I going to sustain all of my personal side as I'm trying to create this business or expand it or so forth. Next slide, please. And here we're going to talk a little bit about the technical assistance side. So this is really key in what the CDFI can provide. And also we do partner with the small business development centers. Earlier today, I believe we had some of that represented, the SBDCs, and we will work with them on putting together these preparation. So, we're going to assist in developing that 3-year financial projections. So the startups, the sales forecast, your pro forma balance sheet and profit and loss, P&L statements. We look at some break-even analysis. So in preparing that first phase, business plans would be in there. They're very important to have a good business plan that's going to basically lay out your mission, what you want to do, how you're going to achieve it. And then these are more of the technical areas where we're going to drill down to the details. Okay, so what are the actual first year sales going to be and so forth. And then we also have a post-loan capacity building. So post-loan services where, we can help to analyze different business costs and budgets, look at those, your performance after your first quarter, your first year, where are you going? How are you achieving that projection? Are you achieving that projection? And then what can we do? Sometimes there might be something else that needs to be done along the way. And then that's the monitoring of that performance. And that's kind of real important, especially in those first year or two, because that's when a lot of businesses fail. So you want to kind of make sure that you're tracking along where you had projected. Next slide. I believe this just has a little extra where accounting and bookkeeping assistance, little job scheduling, and then that good one-on-one technical assistance. So next slide, please. Next slide, please. So we just kind of added a little bit of the accounting and bookkeeping assistance there. And our next slide should be coming up here is basically where do I begin? And so, the serious loan inquiries are going to begin with a face-to-face meeting. That's where we're going to talk about, your work experience, explain, what you do and how you do it, who your customers are, what does your customer concentration look like? Can we try to get to the next slide? We're locked up there. Who owns the business? Here we go. What is the structure of the business? So this is where we're going to sit down and find out, this is where experience is big too. So, are you going to be buying a semi truck or are you already a CDL? Are you going to be opening a barber shop or salon? Do you already have that kind of experience and so forth? So we're going to look at all of those different things, and then we're going to kind of break it down, who the customers are, where is that income going to come from in the first year in those projections. So, you got to really kind of look at, it's not just throwing an arbitrary number down there. Okay, I'm going to make $200,000 in the first year. No, where exactly is that going to come from? Well, I've already talked with, these different providers, depending on the business, and they're going to give me so much business, a year, or I've already established some of those relationships. So this is where that's actually going to come from. So we want to just, kind of drill down on where that, and especially this specifically with startups, but even with some existing business, when we're going to add equipment or we're going to expand the business, well, where is that extra business going to come from to support this debt? So we want to make sure that we're looking at all of those things. Next slide, please. And so, you know, the main thing is the goal of FACC and CDFIs in general is we are here to get you to be a bankable, to help basically fill in that gap where, you know, the banks are not able to help, but we can kind of get that relationship going, get the business started and move it forward. You know, we do focus exactly on more of underserved communities, or in our case, you know, the tribal community, and different CDFIs have different focuses. Therese, you know, with the Milwaukee and Racine area, but we have the same goal, which is to move you through the path to get you to the business banking side, which we'll have a panelist on here in a little while that's going to talk about that. You know, we also partner with them too, with the banks. So real estate transactions, they might take that because, you know, my loan structure is 3 to 6 years, so I might do a build out. They can take the real estate part, and then we can do like participation. So we're always trying to look at how we can make this happen for our clients. So we'll look at all the different possibilities and say, okay, you know, what does it take to get this pathway forward, make you successful in your business, to get you to that end goal. So right here, you know, we're kind of talking a little bit about, you know, just starting the relationship with FACC, executing that work plan, you know, and then you secure financing through FACC or another CDFI or whatever financing source you may find. And then, you know, you build that business. And then once you have, you know, the years of performance, hopefully increasing profitability and so forth, and you graduate as a bankable business, you know. But then also we continue a lot of times to have a relationship with our clients, even as they are bankable, because there's also that post-loan component where we can also help and take a look at that, and, you know, on an ongoing basis, you know, how can we kind of help? Oh, it looks like, you know, business is slipping, you know, where can we step in and maybe make some suggestions or help? Next slide, please. So this is just kind of a breakdown of the business life cycle and that access to getting to the goals that we kind of discussed. Next slide, please. This one kind of breaks it down a little bit more on your numbers along the line there of that life cycle. Next slide, please. Make sure I don't run too much in time here. So typical loan size and purposes. So you can see, you know, about 40% we do a lot of working capital. 12% is our startup. We like fixed assets and vehicles, equipment. It's probably a little bit higher than what you'll see right here. And then the contract financing piece, which again, like I said, we have a little bit of expertise in. Specifically, we have, you know, a little bit more into the contracting side. It tends to be a decent portion of our client base. So we try to focus on that and be very good at that. Next slide, please. And so basically our service area is all of Wisconsin. So we're going to be looking at anything in the tribal communities, anything in those underserved communities. Those are the areas where we try to focus on it and fill in. So pretty much anybody's open, of course, to apply. And we're always here to try to help to put that dream and that vision of that entrepreneur. And if we can't, then we'll find, you know, see if we can help out to facilitate another place that can, or, you know, these small business development, anything like that can help to kind of put together that dream to move you forward. And one next slide is just contact information. If you have any other questions after all this, please feel free to give us a call or reach out to us. We're here to help in any way possible. So that's really what the bottom line is here. Thank you very much.
Awesome. Thanks so much, Rick. Really appreciate it. And finally, we have Wesley McKenzie from US Bank. He's a business banking specialist. So Wesley, the floor is now yours.
Thank you so much, Patrick. I was muted there for a minute. I'd like to echo what Therese and Rick said. They did an excellent job summarizing what you'll need to become bankable as a business and getting prepared to come sit in front of a banker like myself or a banker at a different institution. You need to, first thing I have written down is preparation, preparation, preparation. You need to be prepared. I believe everyone has probably seen or heard about the show Shark Tank. It's a show where business owners come on and they have this great idea and they want to present it in hopes of getting funding from the sharks. And in order for them to make it on the show, the idea has to be good. But the ones that walk away with money and walk away with great deals, they're prepared. First thing the sharks ask them is, how much money are you making? How much do you plan on making? How much does your product cost? How much does your service cost? And if they don't know those numbers, they're dead in the water. So as a business owner, you have to know your numbers. As business owners, the struggle is working in the business versus working on the business. And you've got this dream, you've got this idea, you've got this mission, you've got this passion, you love it, and it's a great thing. But you have to know how the business runs. You have to know the technical side of it. You have to know, how much does it cost for me to make this? How long will it take for me to get my money back? What is the operating cycle of this business? And if you aren't a numbers person, two things have to happen. You either have to become a numbers person or you have to hire one, because the numbers are the lifeblood of your business. There are business owners that, I'm speaking to entrepreneurs and people that are first starting their business out. There are business owners that are working a full-time job, taking money from their full-time job and using it to support their business because they don't know their numbers. They just enjoy what they're doing. And when they take a step back and look at it, the numbers aren't adding up and they're actually paying money to lose money. And we don't want to do that. You're working hard, so you want to know where your numbers are so that the numbers can increase. And you want to know where you are. I work for US Bank. I'm a business banker. I've been here for 6 years. We work with businesses that have been in business for 2 years. In order to get lending from US Bank and the majority of the big banks, you need 2 years time in business. Now, if you are a startup or you're an entrepreneur, you might think to yourself, Wes, just getting started, I'll come talk to you in 2 years. That's not the right approach to have. You want to come talk to me day one so that we can begin to form our relationship. Once we form that relationship, I understand what the business does. I understand what you're trying to do. You open up an account, and in 2 years, we can see the growth of the business. We can see where you started, what you were doing day one. You open up the account, you had a $500 balance, you maintained it around $500, it flowed up and down a little bit. At the end of 2 years, now you've got a $5,000 average balance. We can see your receivables, we can see what's coming in, what's going out, who you're paying. So now when you want to come get a loan, we've got a proven history of what you've been doing, as opposed to you come see me after you've been open up for 2 years in 1 day. Hey, Wes, I want $50,000. Okay, what have you been doing for the past 2 years? Well, I did this, I did that, as opposed to you talk to me when you first open your business, we establish a relationship, and then in 2 years and 1 day, when you want that $50,000, I've got a proven track record of what you've been doing, because for the past 2 years, you've had your accounts with us. In order to be a business banker, you need to be bilingual. Or not a business banker. In order to be a business owner, to become bankable, you need to be bilingual. What I mean by bilingual is that you need to speak banker. When you come talk to a business banker, the main thing that we want to know is, how will we get our money back? If you want to come get a loan from us, how do you plan on paying us back? At the end of the day, that's the bottom line. We appreciate the love and the passion that you have. We understand you have this dream and this vision, and it's going to change the world. It's going to revolutionize the way everything is done. That's wonderful. How does the business make money? And once the business makes money, how can you afford to pay us back? That's the main thing you want to be able to communicate to your banker. When you go sit with a business banker, you're going to come sit at my desk. We'll put in an application for the loan. That loan goes to our underwriting department. The underwriters do not speak to the customer. So any questions that the underwriter has, the underwriter comes back to the business banker, myself, and asks me, what about A, B, and C? The easier it is for me to communicate what you do, or the easier it is for me to answer those questions of A, B, and C, the quicker that process goes. So if you come to me up front, and like I started, preparation, preparation, preparation. You come to me with your numbers, you come to me with your taxes, you come to me with your profit and loss. You're able to explain what happened in these 3 months when, let's say, a payment was late, or there was a downturn in the business. You're able to explain what happened. When the underwriter asks questions, I can immediately answer those questions, as opposed to the underwriter asking me a question. I reach back out to you to get an answer to the question. And once you answer the question, I reach back out to the underwriter to give them the answer. Just makes it a much more seamless process the more prepared you are up front. The other thing you want to ask yourself is, why do I need this money? What if the goal of a business is to make money? So if the goal of a business is to make money and you're actually making money, why do you need more money? What's the plan with the money? You come in and get a loan for $50,000 today, or even if you don't get a loan, let's say you meet an angel investor and they tell you, hey, I've got an extra $50,000, here it is. What would you do with it? And not just how will you improve the business, but how will you use that money to help make more money? How will you grow that money? What type of services or products or innovations will you utilize when you do get that money? And then once you do get it, how will you pay it back? What is the plan for taking this money, making it grow, being able to still support the business and also pay back this debt? One thing that stuck out to me that Therese said was, when you are, both Therese and Rick, they said there's an interview process that occurs. And Therese, she spoke about interviewing the lender as well. If you do get denied or you do get turned down, you want to find out, why did I get turned down? What can I do to prevent this from happening in the future? What can I do to become more prepared? What are my weak spots? What are my areas that I need to improve on? Was there something that I did? Was it my numbers? Is it the business? Is it something that I need to change? Is there someone that you can put me in contact with? Use your banker as a resource, not just, when you need something, or think of your banker like your bankers are people. I know you may not feel that way, but we're people too. We've got feelings, we've got hearts, we've got emotions, we've got families and kids at home, whether or not you believe it. So there are, just like you have friends that only call you when you need something, imagine if you only called your banker when you need something. That's the only time that we ever hear from you. I've got customers, sometimes they just check in, hey Wes, this is going on with the business, just wanted to update you. That loan you gave me, it really helped me out. We're able to do this, we're able to do this. I just wanted to let you know. What do you think I'm going to do when I see that person's name pop up on the caller ID again? Is that one of those calls like, oh boy, like they're calling again? Or is it like, man, like I get to talk to him, I get to talk to her, see how the business is going. Maybe it's growing. Maybe they'll be able to tell me, hey, everything's going great. We're going to reach 5 million this year. So you want to form a relationship with your banker, because business bankers talk to other business owners. As a business owner, you need to have connections with other business owners, because as a business owner, if you just like anyone cold calls you and asks you for a favor, asks you for a deal, if you don't know them and you don't have a relationship with them, you're less likely to provide it to them. Whereas if a friend calls, or a trusted advisor, or someone that you have a relationship calls and says, hey, Susie's getting ready to call you in 5 minutes. I told her all about you. She's a good person. She does this, she does that. I need you to look out for her. You're much more likely to look out for Susie because of the word of your friend. So the same way your business banker, if they call one of their other customers or someone in their network and they say, hey, I need you to look out for Ralph, when Ralph shows up, you're going to look out for him. And the documents that Therese and Rick said, those are all the documents that you're going to need when you come to see a banker. You're going to need your taxes, you're going to need your P&L, you're going to need a PFS. Those are all the things that you're going to need. We want to see the numbers. We appreciate your passion, we appreciate your vision, we appreciate your mission. At the end of the day, we need to see numbers. There are There are a lot of people that can make a better burger than your local fast food restaurant, but they can't make the burger in the same amount of time, as consistent, and for the same price as the fast food restaurants. That's the way fast food restaurants are able to survive. They're consistent, they provide the same thing over and over, and they do it at a reasonably fair price. So you have to know where you are, what you're doing. You've got to know your numbers. I can't stress that enough. You have to know your numbers. When you come sit with a banker, you need to know, do you need a line of credit or do you need a loan? A loan is for a long-term, loan is for something long-term. Let's say you're looking to purchase a building, you're looking to purchase some equipment, you are looking to purchase a vehicle, you know it's something that the business is going to be able to utilize for the next, say, 3 to 7 years, something that you want to pay off over time, you do that. Let's say it's the middle of, you get a loan. Let's say it's the middle of February, the hot water heater goes out and you don't necessarily either have the cash on hand or want to spend all the cash on that you have on hand in order to get the hot water heaters replaced. That's when you want a line of credit. And I cannot stress this enough to all of my business owners. Secure the line of credit prior to needing the line of credit. I can't tell you how often I've spoken with people. I said, hey, you know, I look at what the business is doing. Looks like everything is going really well. You know, you're making money. You've got your business credit cards. You're utilizing rewards points. Let's look at getting you a line of credit in hopes of we establish that line of credit before it's needed. That way, when you do need the line of credit, it's already in place. Patrick, is my time running short?
Yeah, I'm so sorry, Wesley. We have a lot of great content today, and I hate to interrupt you, but we've got about 8 minutes left, and I had a couple questions that I wanted to get answered by the group. So if everybody can pop up their webcams, because I just want to go over a few questions that popped up. So Wesley, thank you. Honestly, I do the same thing that Wesley does, and I mirror basically what everybody else says. So very, very good content today from everybody. So hopefully everybody learned a lot of great stuff today. But a couple questions that did pop up today was, can we to faith-based lending? Can anybody take some time to talk about faith-based lending?
You. All right. Unmuted me. Thank you. Faith-based lending, we do have a few loans to churches in our portfolio. Again, as a mission-based lender, we're careful on all the loans that we look at. So even with our churches, there has to be a give back component. When I say give back, there has to be something that the church is doing outside of regular services to their parishioners in order for us to be able to take a look at a deal like that. But we do them, but it depends on what the whole outlook of the church is.
Perfect.
Yeah, I can reiterate with Teresa. Basically, we're looking at for-profit business, so a lot of times that might fall into that not-for-profit type area. So it just depends.
Wesley, any comments on that?
It comes back to numbers.
Yeah.
It has to make sense. If you're looking to purchase a $3.5 million building and you're bringing in, $1,000 every Sunday, 52 Sundays in a year, that's $52,000 a year. It's going to be a long time before we pay back that 3.5. So.
Right.
Yeah.
Exactly. Yeah, and if so I was going to mention this at the end, but with our contact, if anybody has any additional questions after this, please feel free to reach out to us, because you can use this as connections as well, and we can all maybe connect you up with other lenders that may do this. Another question was maximum lending amount for each of the lenders. Do you guys all have like a maximum that you can lend?
So the max we normally do is around 250, 300,000. That's the cap for us.
Okay.
Minimum is 5,000.
Okay, perfect.
Yeah, we're at 250 is our maximum. We can, board approval for a little bit more and so forth. So pretty comparable.
Okay. And Wes, I know you and I are probably in the millions, so a little bit different.
I think we'll be able to handle the needs of anybody that's watching us today.
Exactly. Yeah. And then the final question I have was, can business connections be included in the business plan? So, for example, if you open up a sewing shop and you have other people in that same industry that may have leftover materials, and you can utilize some of their materials to help with costs, is that something that should be a good idea to include in the business plan?
Are they donating materials to your business? Is that what I'm hearing?
That's kind of what I was taking it as. Yes, correct.
I mean, if it becomes a part of your inventory stock, then it's yours. So, yeah, I would assume so. If I'm hearing you correctly now, if you're going and just picking up yards of material here and there, those aren't your assets. You're borrowing, and I don't know. We don't know if it's borrow at a cost or, what that looks like. But if it's something that is donated to you, is now in your inventory stock, it belongs to ABC Company, then it's yours.
Perfect. Yep, that was kind of my thought too.
And Patrick, I would ask, what's the sustainability of it? Is this a
Right.
one-time donation, or, do you have it guaranteed to where this company every month they're donating X, Y, and Z? So then we can include that in, let's say, whether it's projections or whatever it may be.
Yeah, that's a good point, Wesley.
Yep, exactly.
But it could be a good thing.
Yeah. I have a question, especially for Wesley. So, Wes, if you could provide your contact information. I have a person here that is a U.S. bank customer, at 6 years in business and looking for a relationship with a banker. So she wants to help find a banker who will help minority women-owned businesses. So, Wes, if you can give us your contact information, that'd be great.
Sounds good. Well, my direct phone number is 262-794-1617. Again, that's 262-794-1617. You can reach me via cell phone. You can call or send a text message. And my email address is l.mckenzie@usbank.com. So it's just like my name, first letter L. McKenzie, McKenzie @usbank.com.
So it looks like that's the only additional questions that I had. So now we've got about 2 minutes here. So I want to personally thank everybody for attending today. I want to thank the panelists. Again, all great information. I know that here's my contact information if anybody wants that. I've been in the industry since 2002 in both retail residential lending, as well as last 8 years as a commercial lender. And again, a lot of the things that I'm seeing, hearing today is all things that I also highly recommend. And I'm also part of some of the chambers in Milwaukee as well. So I feel, again, mirror a lot of the things that everybody's saying today. So thank you all for attending. Again, if there's any other additional questions, please feel free to reach out to us. And Wesley, Rick, Grace, thank you again for your time. And you all have a great rest of your day. Thank you again.
You too. Thank you.
Thank you, Patrick.
Thank you.
And thank you all for attending this session. And again, a big thank you to our speakers. We will take a short break and return at the top of the hour in a couple of minutes for structuring your business, things you should know. Again, this is the Wisconsin Lieutenant Governor's Small Business Academy. Our keystone sponsor is U.S. Bank, and this is organized by the Wisconsin Economic Development Corporation. The resource directory for the Small Business Academy is available at www.sbeacademy.com. That is also in the chat. Please visit, and we'll be back in just a moment. Hello and welcome to the Wisconsin Lieutenant Governor's Small Business Academy. This 11 o'clock session is structuring your business, things you should know. Just a quick reminder that we will take Q&A at the end of this session, and you are free to enter questions into GoToWebinar at any time. At this time, I would like to turn over this session to Ken Wondrow. Just a quick reminder, again, US Bank is our keystone sponsor, and Wisconsin Economic Development Corporation is organizing this session. Ken, if you would go ahead and turn on your camera.
I am here. Welcome to this session. I am the moderator today. My name is Ken Wondrow. My email is kenneth.wondrow@scorevolunteer.org. Our website is www.madison.score.org. If you're interested after this session in speaking with either I or Bill Ferguson, who's going to be your speaker, those are ways that we can be reached. I'd like to introduce Bill Ferguson. Bill has been with SCORE for quite a while, and his background is with tax, entity, and legal, and he'll be talking to you about the various things that you're looking at within your small business. Bill, are you out there? I'm not sure Bill is on today. Okay, there's Bill. Welcome, Bill. I just introduced you, so I'm going to let you take it away and razzle dazzle them with all your knowledge on tax and legal entities. So take it away. Oh, Bill, I think you're still muted. Look up in your box in the right-hand corner, the red arrow. There's also a microphone.
Can you hear me now?
Yep, you're on.
Okay, all right. So we're live. All right. Over the next 50-some minutes or so, I'll try to tell you everything that you need to know in how to best structure your small business. If you are a single owner, meaning one owner or an owner with a wife, a spouse, you're considered a single owner. You have the following choices as far as how to structure your business. You can either do it in your own name, such as Joe Jones, lawn mowing, Susie Smith, seamstress, whatever. It's your name. And that's the way it's been done by a lot of people. But lately, people are choosing to form their small business as either a corporation or an LLC, limited liability company. Why this change? Well, there are about 4 or 5 reasons for giving that some consideration. First of all, if you borrow money from a bank or any other financial institution or a private investor, and your business does not go well and it becomes insolvent, and the business can't repay that loan, if it's you that's the name of the business, then you personally are responsible for repaying that loan. If, on the other hand, you are a corporation or an LLC and you borrow the money in the name of the corporation or the LLC, you probably will not be called upon to pay that loan if your business becomes insolvent. All right? So that's one reason to either incorporate or form an LLC. Now, I'm not suggesting that you should figure out some way to avoid paying your just debts, but as a professional presenter, I have to tell you what's available, what's out there. And everybody, for the most part, is using these things, and that's the name of the game. So lenders know that if they loan money to a corporation or an S corp, that there's no way they can get to the individuals if that business becomes insolvent. So for that reason, they nowadays typically will ask you for a personal guarantee. And so don't be too surprised if just before getting that check for the money you're borrowing, they say, oh, by the way, we want you to sign a personal guarantee. And if so, more than likely, you'll have to pledge your personal stock portfolio or your home or your vehicles, etc. So if that's the reason you're forming a corporation or an LLC, it might not work if you're going to be called upon to do a personal guarantee. But there are other ways that a corporation or an LLC can be in debt, and that is just operating their business. They typically would purchase things from other businesses on credit. That's usually the way businesses sell to other businesses. They give you 30 days or 60 days to pay. Well, if that's the case, you might be able to skip out on having to repay those debts because they typically don't ask for a personal guarantee. Again, I'm not suggesting that that's the way to go. I'm just telling you what's available. And everybody that's in this business knows what's available, and they know there are risks in dealing with another corporate entity. So everybody is well aware of how the game is played. But the third reason is far more important in my judgment, and that is, what if in the course of selling a product or performing a service, you injure the economic welfare of one of your customers, and they sue you, and it could be big dollars? What's your defense? Well, if you've made it clear that you're a corporation or an LLC, for the most part, the only thing they can do is sue your corporation or your LLC and then try to recover damages from the assets that are inside the corporation or the LLC. All right? Now, I'm not suggesting, oh, well, let me just remind everybody that, yes, you can get sued. You might think, oh, well, I'm not doing anything that would cause me to be sued. Well, that's what McDonald's thought when they sold coffee to this lady who spilled it on her legs in her car and sued them. And I believe she won a verdict. And you might say, well, I'm just, all I do is rent 4 units in a duplex, so I don't know how I could get sued. Well, somebody comes on your property and slips on an icy sidewalk and hits their head and dies. Who are they going to sue? It's going to be you, the owner of the property, and anybody else they can sue. So for that reason alone, I would say always form your business, run your business in either a corporation or an LLC. Now, you might say, okay, fine, you've convinced me. Which is better? Well, in my judgment, under the tax laws right now, I can say 90% or more of the time, it's probably better to form your business under an LLC. And the reason is, if you form it as a corporation, now you're stuck reporting your business activities as a corporation. You must then file a corporate tax return. You have to now become an employee of your own small business and pay yourself a salary. That means quarterly payroll tax returns and W-2s. And in the course of having to file a corporate tax return, you're going to need to keep better books than just scribbling stuff down on the back of an envelope. So all of this makes life a little more complicated, and it can get expensive if you need to have an accountant do all this work for you. So it's something to think about. And we were back to the question of, well, which is better, the corporation or the LLC? And my point is, with all that complexity of filing as a corporation, you might want to avoid that. And the only way of avoiding that is being an LLC, because as an LLC, you get to choose, excuse me, you get to choose how you want to be taxed for your small business. You can still put all of your business activities on your own personal tax return and keep life simple. Forget the corporate tax return and the payroll tax returns and all of that. Just keep it simple. Put it on your own personal tax return. So that's the benefit, the overriding benefit, in my opinion, of choosing an LLC over a corporation. And as I understand it, they provide almost identically the same corporate legal protections, whether it's a corporation or an LLC. I'm told that even today, 80% of all small business is actually done by LLCs that have elected to be taxed as an S corporation. I don't know if that's measured by sales volume or by the number of units of businesses, but it's still mighty impressive and demonstrates the appeal of being an LLC and electing to be an S corporation. So let's talk about, okay, what's the difference now between a regular corporation and an S corporation? We call a regular corporation a C corporation, C as in Charlie. And the other alternative is an S corporation, S as in Sam. Which one of those two entities is better? Well, legally, it's the same thing. So now we're talking about just the tax ramifications. And while it might be tempting to file your business as a C corporation because of the low C corporation tax rate, it's only 21% now since 2018 with the new tax bill. It dropped from as high as 35% down to 21%. Well, that's tempting because you might, as the owner of a small business, either have another job where you make a ton of money, or your spouse has a job with a good income, and you're in a high tax bracket, which I think is 35% now, the highest. So you say, why would I opt to pay 35% when I can be a C corporation and only pay 21%? Well, the problem is, let's assume your C corporation makes $100,000 after business expenses. So you pay 21% to the federal government, ignoring the state governments for the moment. That leaves you with $79,000 of untaxed income in your C corporation. Well, how do you get that out of there? Well, you can borrow the money as a temporary measure, but you have to pay that back, plus interest. So the only real permanent way of getting that money out of there is to pay a dividend from your C corporation to yourself. And that more than likely would be taxed at, say, 15%. So now you've paid, well, 15% of 79%, which is about what, 12%. So you've now paid 21% at the corporate level and effectively 12% at the individual level. That's 33%. So I don't know that it's doing you any favors. It might. It depends upon your circumstances. If you truly did have a lot of other income and you're in that 35% bracket and along with state taxes and everything, it might work for you to be a C corporation, but typically it does not work to be a C corporation. And there's another issue with being a C corporation. By the way, if anyone has a question along the way, write it down in the chat box, and we will get to those questions at the end of the session. And if you think of a question later on, today, tomorrow, next week, next month, next year, send me an email and I will answer it for you. Send it to my personal email, which is F as in Frank, ERGY, Fergie, 53711 at yahoo.com. I like to use my personal email rather than my SCORE email because I look at that more often, almost every 15 minutes. I'm addicted to looking at my personal email. I don't look at the SCORE email every day. So the best way to get a quick answer is send it to me in Fergie53711 at yahoo.com. Be happy to answer it for you. All right, so we talked about the tax structure of a C corporation. Oh, but there's a second problem with being a C corporation owning a small business. If you are successful and it comes time to sell your business and move on, typically you will wind up selling the assets of your business. And when a C corporation sells its assets, it pays a tax. Once again, the 21%. But now you've got all the money inside the C corporation, which needs to be dividended out, and then you pay the dividend tax. So there's the form of double taxation, no question about it. As I said, I think 80% of small business is somewhere around 80% or more run by S corporations. Well, how does an S corporation work? Well, it's a corporation under the tax scheme of things. You file a corporate tax return, you pay yourself a salary, and you pay the income tax on the corporate income because it's a flow through to you. All right, so that's the difference. In the C corporation pays the income tax, and then you pay the dividend tax. In the S corporation, you pay the income tax on all the income. All right. Now, you are obliged as an S corp stockholder employee to pay yourself a salary. And the Internal Revenue Code requires you to pay what they call a reasonable salary, whatever that means. That's in the eyes of the beholder. Excuse me. So what is a reasonable salary and why is this even important? Well, here's where some tax savings come into play. let's say after you pay all your business expenses, you have $50,000 of net income. If you report that on your personal tax return, typically on Schedule C of your personal tax return, the first thing that happens is you will pay very close to a 15% payroll tax. This is the equivalent of what employers and employees all across the country pay for employment status. But you are now paying the equivalent of that. It's often called the self-employment tax. So 15% comes right off the top. 15% of $50,000 is $7,500 just for the payroll tax. Then you will pay income taxes on the entire $50,000. And if you're in federal and state, maybe close to a 30% bracket, that's 45% total tax on that $50,000. That's $22,500. That's almost half of your income. So how do you improve upon that situation? Well, you opt to file as a corporation. You make the same $50,000 after expenses, but instead of paying yourself a salary of $50,000, you decide to pay yourself a salary of, let's say, $30,000. Now the payroll tax only applies to $30,000 rather than the full $50,000. So you've just saved 15% of $20,000, which is $3,000. That's some righteous bucks. And if you do that every year for 10 years, that's $30,000. There are some problems with this. First of all, the IRS is fully aware of what they call this gimmick. Some of them might even call it stealing from the Social Security program, which we all know is in need of money. So the IRS from time to time issues rules that don't let you play this game. And every time they do, Congress comes in and says, no, 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 no. We will solve this problem. We're aware of this problem and we will solve it. Well, this problem has existed since 1987, when everybody switched from C corporate status to S corporation status. That's 41 years that we've had through 2017, that we've had everybody operating as an S corporation and paying themselves as low a salary as they think they can get away with and saving payroll taxes. You don't save any income tax. That's the same. But you do save that 15% off the top of the payroll tax for whatever amount you don't pay yourself in the terms of salary. But if you get audited by the IRS, it might be very difficult to justify paying yourself $30,000 if you're earning $50,000 and you're the only one working for your small business. You'll probably lose that argument and have to pay the back payroll taxes that you didn't volunteer to pay in the beginning. And it does happen. But a lot of people have gotten away with it and will probably continue to get away with it. And so once again, as a professional presenter, I have to tell you what's out there. But just be aware of the fact that you could get audited by the IRS and have it overturned if you pay yourself too small a salary. I picked 30,000 out of 50 because in my mind, I don't know how you can go below 60% of the net income. I know you can and maybe get away with it, but in my mind, that would be awfully hard to justify. And keep in mind that if you're talking about making 100,000 of income after expenses, you pay yourself 60, you've now saved 15% of 40,000, that's 6,000 a year. Again, subject to IRS scrutiny, perhaps. Now, you might have another expense if you decide to go this route. Unless you want to become an accountant and a payroll tax compliance person, you probably will need an accountant to help you do all of this. File your corporate tax return, file quarterly payroll tax returns, W-2s at the end of the year, and the state equivalents of these things. And that could cost you easily a couple $1,000s to have all that work done. You won't be able to just turn in a bunch of stuff on backs of envelopes and scrap paper. Your accountant is going to want to see a legitimate set of books with a balance sheet and an income statement. And so you might even say, well, I'll just have you do that, accountant. So it could be more than 2,000 if they do your routine accounting along with the tax returns. So in my example of saving $3,000 based on 50,000 of income, you could easily eat that up with accounting fees, easily. If it's 100,000 that you're dealing with, well, okay, now you can afford to pay an accountant $2,000 or even $3,000 and still save an equal amount of that and hope that the IRS doesn't upset the situation. So that's the way the game has been played, as I said, for 41 years. Starting in 2018, we had a new tax law that introduced something brand new, and that is that small businesses basically only need to report 80% of their income as subject to income taxes. In other words, they get a phantom 20% deduction. It's called the Section 199 Cap A deduction, or the qualified small business deduction. Goes by either one of those. So what does that do to our calculations? Well, getting back to my example of 50,000 of income after expenses, and we're only going to pay ourselves 30. So we've saved 15% of 20, which is $3,000, but maybe we pay $2,000 to an accountant. So now we've only saved $1,000. You've also just lost some of that 199A deduction, because the 20% deduction only applies to the income left over that hasn't been salaried out to the owner. So in my example, if you've salaried out 30,000, there's only 20,000 left that's subject to that 20% deduction. So you've just lost a tax deduction on $4,000, which easily would be worth another $1,000 at a 25% tax rate. So now you're practically back to zero, where it's hardly worth talking about. Again, if you're planning on making $100,000, then yeah, it gets to be a little more beneficial and justifiable. to elect to file as an S corporation. Let me point out that you do have some flexibility here. You don't have to make a decision today in your first year of business and then you're stuck with it. No, you can start one way and then the following year decide to go a different way. But bear in mind, if you elect to be an S corporation and a couple of years later, it's not working for you economically and you get out, which you can do, you can't go back in again for 5 years. Now, I realize all of this is terribly complicated, terribly dependent upon numbers and percentages, and it's like shooting a moving target because it all depends on how much income your family has, husband and wife. So I can only recommend to you in the strongest of terms, please do get a knowledgeable small business tax practitioner to help you with this. I'm more than happy to answer any of your questions, but for me to dig into your personal situation and ask your other income and make calculations, no, that's not what we do at SCORE. We don't do CPA work for clients. We're precluded from doing that. But I can certainly answer some of your questions or tell you where to look or whatever. But my point is, please do associate with a knowledgeable small business accountant that can help guide you through this. And to add to the further complexity, to add to that, as I understand it, this 199A deduction is due to go away after 2025, or it goes away in 2025. I don't remember which it is. But then isn't it true that Congress more often than not extends these temporary programs? They find out that everybody likes it and they don't want to get rid of it because that constitutes a tax increase and nobody likes to be responsible for a tax increase. So they extend a provision that was due to lapse. So I don't know, between now and 2025, you may need to look at this situation and make these calculations on an annual basis. And the critical due date for making a decision to be an S corporation is March 15th of each year, where you file a form 2553. Excuse me, I gotta shut this down. You file this form by March 15th, and then you are considered an S corporation for the entire year. That's what most people do. If you file it late, you could possibly ask the IRS for an approval of a late file request. And I understand they're almost routinely granting it. But why go through all of that? IRS being terribly busy these days. I would just try to get that decision made by March 15th and that form filed. So that, in summary, covers it, I believe, for a one-owner business or husband and wife here in Wisconsin, anyway, a community property state, is considered one taxpayer. So the things to remember are, number one, you should probably always file or create your business as an LLC. This gives you a little bit of extra protection especially if you get sued for something. And let's face it, folks, people sue other folks for reasons that are inappropriate, not justifiable. So you do want to protect yourself. Second thing is always get the appropriate insurance. Align yourself with a knowledgeable small business insurance broker. And the nice thing about it is, if you do get sued, you don't have to run around like crazy trying to find a lawyer to help you. The insurance company is there to help you. It's them that may have to pay the bucks, so they jump in and do the fight for you. So that's two things. Form your business as an LLC, get adequate insurance, and give consideration almost each year to whether you want to file as an S corporation or just keep life simple and put everything on your personal tax return. The beauty of being an LLC is that the IRS treats this as a disregarded entity. In other words, it doesn't exist under the tax rules. It's just a legal concept. There's no form for filing an LLC tax return. It doesn't exist. You either file your business on your personal tax return, Schedule C or maybe F if it's farming, or E for other things, rentals, or you file a corporate tax return, either C or S, which is the 1120 series, and follow those rules. And once again, I can only say that I highly recommend LLC and S election, but be careful of the trade-off of Section 199 deductions and the threat of maybe having too low a salary turned around on you and things of that nature. And just by all means, get the help of a knowledgeable small business practitioner. Now, so far we've been talking about a one-person ownership or husband and wife. What happens if there are two or more of you unmarried to each other? What are your alternatives now? Well, you can't file the business on your personal tax returns because you're essentially in business together, two or more unmarried people. You can't do that. You are required under the tax rules to either file a partnership tax return, Form 1065, or elect to be taxed as a corporation and file either a C corporation or an S corporation. You can't file on your personal tax return anymore. That's the tax elections that are available. What are the legal options that are available? Well, you can't file under your own names anymore because there are two or more of you. So you either need to be a corporation, an LLC, or something called a partnership, a limited liability partnership, LLP. So you've got LLC, LLP, and corporation. An LLP provides the same legal protection, as I understand it, that an LLC or a corporation does. But it's designed for people who want to be treated as partners in a partnership. But it provides for the legal protection. Without that, if you just form a partnership, now you're treated as what's called a general partnership, which means each partner is liable for all of the debts of the partnership, regardless of the ratios of ownership. And that's kind of scary. It's called joint and several liability, and it applies to any general partnership. And the creditors of your business, if they go after you as individuals, they don't have to go after each and every partner. They can go after the one that's most easily found and or has the deepest pockets. So it's kind of scary. And for that reason, general partnerships aren't too popular these days. The LLP is generally now the way to go. It used to be partners would file legally as a limited partnership, but a limited partnership requires at least one general partner. And that means at least one partner, as the general partner, is responsible for everything, even though the limiteds are not. The problem with that is the limiteds can't be involved in the business legally. If they want to be treated as limited partners, they have to stay out of the business, running the business. They can look at financial statements and maybe have a meeting every once in a while, but they can't be involved in the day-to-day activities. Well, the LLP allows for everybody to be involved, all right? And you get the legal protection. So where does that leave you for tax purposes? Well, if you form a corporation, now you're stuck with filing a corporate tax return, either C or S. And as I said, C's are just not a good idea these days. But so you would then elect to be taxed as an S corporation, pay yourselves salaries. Or you can form an LLC and then have the flexibility of choosing to be taxed as an S corporation or choosing to be taxed as a partnership. Again, LLC gives you the flexibility, and that's why I can generally always recommend it as the way to go, LLC. If you form a LLP, you're stuck with filing your taxes as a partnership, Form 1065. And you're probably stuck with greater amounts of payroll taxes. And excuse me for that. I thought I had turned my phone off. I guess I didn't push hard enough. Anyway, with a LLP, you're probably going to all be stuck with higher amounts of the payroll tax, that 15% tax. So, the other thing to keep in mind, whenever there's more than one owner, you're in a group of owners, two or more, you need to really think through how you want to deal with what I call the 4 Ds. The first one is death. What happens if one of your partners dies? How do you want to deal with that? Do you buy him or her out? Or do you bring his heirs into the partnership? Typically, you don't want to do that. So you need a mechanism to buy out the decedent. Well, you need to have money to do that. You can't just go into petty cash and buy somebody out. So you probably need to get life insurance on one or more or all of the partners. The second D is disability. what if one of your partners who you count upon to do a lot of the work gets disabled? Well, you might have to, if it's permanent disability, you might want to ask him to leave, which again means buying him or her out. Where do the funds come from? Well, you purchase disability insurance or something like that. And you arrange ahead of time how to calculate the value of the company if one of these events occur. The third D is divorce. One of your partners gets divorced. Do you want his or her ex-spouse as your partner? I think not. So once again, you would want a mandatory buyout. Once again, that requires a mechanism for calculating the value of the company. And it also requires you to figure out where you're going to get the money. Typically, with disability and divorce, the payout of a partner that you're buying out is done over a period of years, like 5 or 10 years, because typically you don't have the money to just pay the whole thing all at once. So it's done over a longer period of time. And all of that is provided in the LLP document or the LLC document or the corporate document, whichever the case may be. The final D is what I call departure. One of your partners just wants to go. He or she has had enough, wants to move to Florida. They're done. How do you deal with that? Once again, you got to have a provision in your agreement to buy that partner out, and how long of a period of time to make the payments. And I know in a small group, when you go into business as partners, they may be friends of yours, they may be relatives, and everybody's in agreement, and nobody thinks there'll ever be a problem dealing with money. Well, I hate to say this, but sometimes money can really change people, especially in a divorce. I mean, that can get truly ugly. I'll just mention a personal thing that happened to me when my younger brother passed away. My father felt that he should get all of my brother's money because he was the only parent left. My mother had died. Well, my brother had a will that he gave a fair amount of his money to friends of his that he had had for years. Some to myself and my family, and some to my father. My father just refused to accept that. And he and I never had a good word with each other for the rest of our lives, rest of his life. It was always a bitter conversation about money. So you just need to cover yourself for the situation, all right?
Bill?
Yeah.
This looks like probably a good time to cut in. We've got about 10 minutes left, and we have some questions that Michael is going to read out to us.
Yeah,
and
let's
then
do
we
that,
just need to close out.
Yeah, let's do that.
Perfect. Thank you, Ken, and thank you, Bill, for presenting this whole hour. We'll start with our first question that came in earlier. If corps require a personal guarantee, how is it that the individual is not personally liable if sued or if bankrupt? Is the personal guarantee only for loans?
Yes, for the most part. You don't personally guarantee an injury. Like, yeah, if anybody gets hurt, I'll be personally responsible. No, it's typically just for loans.
Okay, perfect. Next
And
question.
you volunteered to do that under the terms of the loan. So that's it.
The next question was, and I'm just going to read this. I keep hearing about series LLCs, but I can't find much written info about it. Can you explain more about these, how they work? The
Say
pros
that
and
again. What kind of LLCs?
Series
Series.
LLCs.
Series.
Can I jump in? I'm guessing, but I think what they're talking about is that one LLC has as a partner another LLC, which has a partner.
Okay.
So you get a kind of a chain effect. With those, that's pretty complex, but we find them sometimes in farming operations where one LLC is owning the equipment and the buildings, another LLC is actually doing the farming, and the sons may be as involved as separate LLCs. We don't recommend them if they need a really precise reason for trying to set those up. But basically, you're just taking an LLC and treating it as a partner. So now all the partners in that other LLC become sub-partners of the larger LLC.
But there are lawyers that will recommend a separate LLC for every significant amount of rental property.
Mm-hmm.
So if someone gets injured on that rental property, the only assets available to be taken away by the claimant would be that property and none of the others. So there are some benefits there.
Yep.
Next question.
The question is, you can only deduct 20% from 1 year's taxes?
From 1 year's small business, yes.
So again, if a small business had net income of $100,000 that they're reporting on their tax return, they would be able, again, this is dependent on other numbers on the tax return, but in theory, they would get to subtract $20,000 from their tax return. In the next year, then that repeats again. So in the next year, whatever their income is, 20% of that could be a potential deduction against income tax.
Very good. The next question is just the QBI question mark until 2025 question mark.
Yeah, that's the 20%, and it's due to lapse either in 25 or after 25.
After the 2018 tax bill was up through 2025. After 2025, all bets are off. We could go all the way back to what we had in 2017 for tax law. I agree with Bill. There'll be all kinds of extensions. Back in 1998, they had a major tax bill, and for the next 20 years, they've been extending pieces of it. We still have energy credits. We have all kinds of different things that get extended. It's just that Bill and I, any other tax preparer out there, any tax professional, will never guarantee anything. We have no idea what Congress will do. In 2025, I have no idea what the makeup of Congress will be. So your best bet is operate on the laws that you're currently under. As Bill said, certain actions that you take can be undone. The process, though, of when you undo something, you tend to have to wait to get it back into the other shape. So just always be working with a professional who's looking at the numbers and looking at the situation. Is there another question out there for Bill?
Just the last question is filing taxes as a partnership or LLP exclusive from being an S Corp? Can both situations not be true?
No, you can only be one or the other. You either file as a partnership on Form 1065, or you file as an S Corp under 1120S. And the rules are different. There are some benefits to for filing as a partnership versus an S Corp. And that would be if you bring in new partners who buy in, they get to step up the basis of assets to equal their investment, whereas they don't get that if it's an S Corp. So once again, it's loaded with complexity. But other than that step-up possibility, and that also occurs if one of the partners dies and so forth. Other than that, the S Corp probably has some benefit with the lower salaries, whereas the partnership, it's all guaranteed income and subject to payroll tax.
Okay, and we have had a couple more questions come in, but we're more or less out of time. Both of your email addresses are in the chat to the audience again. So if the audience has additional questions, they should be able to reach out to you directly.
Absolutely.
I just would like to say thank you to both of you for presenting this hour. Your service to the small business community is much appreciated. And thanks to all of you who were on this session for attending and learning. I think it's great that we're all dedicating ourselves to doing business well in this session. Again, I'd like to remind you all that this is the Wisconsin Lieutenant Governor's Small Business Academy. And this hour's session was structuring your business, things you should know. And I think Alex with WEDC has a few things to say at this point.
Hi, again, yes.
Alex, can I jump in just for 1 second? I just wanted to remind all the viewers out there that a mentor from SCORE is free to them. They just need to go into our webpage at www.madison.score.org. Reach out with your question. A mentor will come in and help your business at whatever stage it's at. Thank you.
Yeah, so there are all sorts of free resources out there, folks. The resource directory is out on when you registered for the sessions that are out there. Take advantage of those. Reach out to those regional resources. They're certainly out there. As everybody spoke today, thank you so much for joining. Tomorrow, our virtual session starts at 9, but if you are fortunate enough to join us at the face-to-face sessions, they start at 8 o'clock. And so from 8 to 9, there's going to be some mingling, some registration, some light refreshments. So I hope you are able to join us. Again, the session starts at 9, and it'll be the US SBA Award Winners Panel, Resilient and Persistent, Wisconsin's US SBA National Small Business Week Winners Panel, and how they keep it going. Wow, that was a mouthful. All right, so we will see you all. Thank you so much for participating, and thank you for attending, and you all make it a great day. Thank you.
Thank you for thanking me.